Welcome to the More Doors Podcast, episode 20. There we go. A little first initial milestone.
That's it, number 20.
20 of millions more. Today, I'm very excited. We have a special guest, Mr. Chris Pomerleau. We're going to get started right now. All right, welcome back to the More Doors Podcast, episode 20. I'm excited today, boys. I feel good.
We can tell.
We did it. We've been in front of these microphones all day.
I love it. Stack them up, man.
We did a webinar earlier.
First webinar today. It's pretty exciting.
Now we're doing a podcast episode. We should just do some random fun video content after this. Just stick around all day and just shoot commercials.
But I love the guest today, Chris. The dude's amazing.
Yeah.
Got a lot of great strategies. What he's built up is awesome.
All
So
right, well,
he's got the best hair out of
I
all
agreed
of
to
the
do the
people
intro
on this
today,
podcast.
and you're already done. So here we go, Nick, with
you,
the intro.
You can handle the intro, but I'll handle the sponsors.
He couldn't let go of the control.
That's
He
right.
couldn't let
That's
go.
right. I'll handle the sponsors. Look, today's show is sponsored by Deep Blue Capital, right? So all you need to do is go to deepbluere.com. Go there first, but then listen to this. Look, if you want to invest money, maybe you want to become an investor in a multifamily project, but you don't know where to start. Number one, you can always go to the webinars that Deep Blue Capital puts on. They just put on how to buy your first apartment complex in 90 days. So that was a great one. Their next webinar is going to be how to operate that apartment complex, because once you buy it, you need to know what to do with it. But just go to deepbluere.com and see what investment opportunities there are, see what current projects they've invested in and how they're going. Right. And just get on our newsletter, deepbluere.com. And then, of course, if you want to build a show like this, we're thankful to have an amazing studio. Chris just complimented how great the studio looked. And it's all because of Jesse at torstudio.com. So go to torstudio.com if you want to go build a podcast and just become famous like Matt Buchowski.
I don't know about that. Jesse does have the best beard ever, though. So when you reach out to him, make sure you remind
Chris
him.
has the best hair. We got Jesse with the
I'm
best
letting
beard.
the compliments flow today.
Yeah, you're in a great mood.
I am.
I don't know what's going on
for a change.
This is scary. real scary.
This is what happens when we start lining up LOIs. I get all giddy.
Yeah. Talking about excited.
Two yesterday, maybe one more today.
Maybe one more today.
Maybe one more next week.
Yeah, it'll be a good time.
That's it.
All right.
I'm gonna go out like Brian and buy a bunch of really tight shirts to celebrate.
Yeah.
What you guys don't realize is these shirts.
You made them?
It's my body that's tight.
Did you sew that shirt?
I didn't have to.
Did you tell Chris that you have your own sewing machine?
I
yet?
I do realize that I make a lot of points about me tailoring my own clothes.
You do.
I have awareness around this now.
Okay, good.
I kind of feel like every time I say it, it's the first time I'm saying it, and then I'm reminded that I've told people.
Every time
before.
you listen to the show, you're like, "Shit, I said it again for the first time."
Exactly.
I will say I did feel like Brian yesterday. I was wearing joggers and I pulled them up a little bit because Brian wears his jeans a little higher.
He does.
Like they're capris. And so I had the joggers on and I was like, oh, this is going a little Brian Force style.
Oh boy.
So look, our guest today is Chris. I'm not even going to say his last name.
Pomerleau.
See, I did it right.
See, if you did that better than Gino's last name.
I messed up Jake and Gino. Barbaro. Is that better?
Much better. Thank you.
Much better. Yes. So I'll let Brian take over the intros on this.
Nick's losing his voice.
Yeah, I'm telling you. I told you that's why I wanted you to do the intro.
All right, fair enough. I am excited. I'm excited to have Chris Pomerleau on. He is the co-founder and the director of investment strategy over at LeavenWealth. And man, they have thousands of units in AUM. They also are vertically integrated in a very, very, very impressive way. And I really want to dive into that aspect as well, because it's something we've been talking about in our business. So let's welcome Chris on the show. Chris, how are you, brother?
Awesome, gents. Thanks for having me.
Sorry to make you suffer through. What's become our trademark is we keep guests waiting in the green room while we banter.
Look, I could have listened for hours. This ripping is hilarious.
I appreciate it, brother. Well, welcome to the show, man. We're super, super excited to have you on. We hate doing the normal, like, let's just read his bio, right? give us the 30-second or however long you want to take an elevator pitch on who is Chris. Tell us a little bit about your journey, and I keep slamming the table today. I'm sorry, and how you got to where you are now. A little bit about your company and everything we need to know.
Yeah. So founded LeavenWealth Capital. So just I'll try to make it 30 or around their seconds. Born and raised in the Omaha area. I went to undergrad in South Dakota. After that, I went to law school in Omaha. I was in the military for a few years thereafter. And then I practiced law for the next 10 years, starting in 2013. While practicing law, I was building up our real estate portfolio, and it became clear to me as I got towards the end of that we could actually make this into a full-time business. And so I exited the law in 2022, but we had started multifamily in about 2017. So as of today, with LeavenWealth Capital, we have about 2,700 doors under management right now, and in ownership, about 240 million in assets under management, and in 7 states. So basically South Dakota, and then every single state south all the way down to Dallas, Texas, Dallas and Fort Worth. So we're buy and hold investors. It sounds like I heard some of your past guests, Jake and Gino, like them. I mean, we like to buy, we like to refinance, we like to use that money and go out and repeat our approach, and that's us. That's us. I got a second business as well I didn't mention. So LeavenWealth Capital is where all of our investors come in and they help long-term wealth and multifamily with us. Our second business is Liquid Lending Solutions. That's a hard money company. We lend to investors. So we've lent out over 65 million thus far, a little over 260 notes. And our investors are, our borrowers are real estate investors themselves. And so as you'd imagine, just like the equity company, it's built off of investors. We take on investor capital, we lend it out to our investor base, our borrower base, and everyone makes money throughout the process. So that's a little about me. Married, 2 kids, 5 and 3, and I have great hair.
He does have great hair. He does have great hair. I think, honestly, I feel like the left out one on this thing, because my hair is going away quickly, and Nick's got the gel and the spike, and you got the gel and the spike, and I mean, Chris is just, I mean, it's gorgeous, man. Good job.
Yeah, I appreciate that. For anybody who ends up watching this and wants to tell me about how conceited I am, you had joked with me earlier that my hair was nice, so that wasn't out of left field.
That is
no.
That
I'm being very, very sincere about it. You know, I'm not ashamed to say it. I mean, shit.
True. Well, Chris, I want to back up just for a second. You have done you've done what so many multifamily investors aspire to, which is get to a point where you go, you know what, it doesn't really even make sense for me to continue on what was originally my career path. I need to be a full-time real estate business owner. How did you, what did your first foray into multifamily investing look like? How did you pull that Band-Aid off and go, I'm going to commit to this and I'm going to get this deal done? And then at what point did you realize this needs to be the thing that I'm doing full time?
Because they probably don't teach that in law school.
They definitely don't.
Yeah.
I don't know what they teach in law school.
Just a lot of debt.
It's tell me about it. Yeah, 2013. So I had read Rich Dad Poor Dad. I'm sure you've heard that answer 100 times, but it was kind of my first intro to it. But during law school, I was in the military in the morning. I'd go to law school all day, and then at night I was getting my master's in negotiation and dispute resolution. So I read Rich Dad during law school, but actually implementing anything in that book was very difficult, because at the time I was like, I have no time for this.
Yeah.
And so I graduated law school in 2010. I was in the military. Did the military thing till 2013. When I got out of the military, I practiced law, and that's when I said, look, now I have downtime. I was still working ridiculously large amounts of hours, but I had some income, and that's when I dove in. 2013, bought a single family home, and for round numbers, actually I'll use exact numbers. We bought it for $100K, put about $30K into it, and ended up refinancing, getting all of our money back. It cashed with about $200 a month. And we just rolled that money on the refinance into the next one. You know, what I learned quickly, quickly is probably not the right word. 4 years later, I had 4 single family homes that I had done that on, but that pace was way too slow. And the mistake I made, I was doing it all myself. You know, you had mentioned earlier about vertical integration. I was laying the flooring, changing the toilets, running it to tenants. And so 4 years later is when I said, look, it's neat to have $100 a month in cash flow, but I've had a second job for 4 years and I have 4 single family homes. I need to start scaling this and figure out what makes the most money and turn this into a business. And that's when I jumped into multifamily in 2017.
Wow, fantastic. I mean, how many times
We just talked about this like an hour ago.
Yeah, well, this is why I love these stories.
Yeah.
There's a like an anecdote of, I don't know if you've ever had this experience, because you said, I know you've heard that answer 100 times about reading Rich Dad Poor Dad. You ever run into investors that you're like, they almost talk shit about that book or whatever because it's so popular.
Yeah.
And they're like, well, have you read that book? And they're like, no. And you're like, okay, well, if you heard something 100 times, maybe pick it up.
Yeah. Maybe all these people who have become very successful and they've all read the book.
Yeah.
Maybe that's a clue.
Nah, that's lame.
It doesn't tell you what to do. It just changes your outlook on how to make money and the importance of passive income. And it's really like it's rumored to be even a fable, but if it changes your mind of how you're outlooking on something, that's what I needed. And it did change my mind, but in law school, in the military, and in grad school, while living in my mom's basement, it just was too much.
Sure. Sure. I get that.
I mean, just listening to that schedule every day is exhausting.
Yeah.
Military in the morning, and then law school during the day, and then a master's in negotiation at night.
Yeah, but I was 23 to 25. I had a lot more energy back then.
Fair enough. Well, you're living proof of what we were talking about a little bit earlier on the webinar that we're doing is, if you're going to do something, despite what other gurus or podcasts or whatever might make you think, it is a commitment. You've got to just accept that multifamily investing, real estate investing in general, but multifamily specifically, can build you the type of financial freedom that most people dream of. And it can build you the type of generational wealth that most people aspire to, but never achieve. And you're going to have to super commit to it.
Yeah.
It's just not something you're going to fall into and be successful at. You can certainly invest in multifamily deals on a limited basis and make great returns. If you're trying to become an operator and this is your business and what you want to do, you have to treat it like that before it even pays you. You just got to jump in and commit to it.
Mm-hmm.
Yeah.
There's a difference between interest and commitment, right? And there are some people out there that get really fired up about things, and they get really motivated and they get really excited, and then it gets hard and like, I'll move on to the next thing. And there's other people that just aren't going to stop until the job's done. Yep. It sounds like Chris is one of those guys.
Yeah, absolutely. And so I want to flash forward, right? You guys have thousands of assets under management now, or thousands of units under management now. You guys have done something that most successful operators aspire to and can be a massive enhancement to your returns and your business plan. Now you guys have become more vertically integrated. You have the in-house construction, in-house property management. When was it the right time to start to vertically integrate and it made sense because it is a lot of work? And two, what does that look like from an operation standpoint as you manage essentially your own company that serves you as a client? How does that add to your workload, or does it actually streamline things? What are the limiting beliefs that people have around those types of vertical integrations?
Oh, I think you hit the nail on the head there. It doesn't add to my workload because of the scalability. It streamlines what I do. And to be honest, much to the dismay of my late father, I'm the least manly guy you know. I don't want to lay flooring. I don't want to lay toilets, change toilets. I don't want to turn wrenches. And so that wasn't the best use of my time.
Yeah.
And certainly because of driving someplace to show a unit, but also because if you want to scale a business, you can't do everything yourself. You should probably latch on to things you're really good at and allow other people to take over at things they're really good at. That's why we have a CFO. He's a CPA. He knows what he's doing. And I used to run all the numbers for the business, but once we grew enough to hire someone who's even better than me, that's exactly what we should do. In fact, in my opinion, any CEO or someone starting a business, you should be surrounded by people who are subject matter experts in any single field they're in, and they should be better than you so they can carry the damn thing. It's kind of like why George Bush Jr. was a president. That guy wasn't really the smartest guy in the room, but what he was smart about is he picked a good cabinet. He understood he wasn't, and he picked a good cabinet. I'm not going to call myself George Bush for a number of reasons, but I would say that's why we're successful. And I think having the property management made the most sense. It took me a while to learn that. I managed those 4 single-family homes myself. But once we started getting to multifamily, and it really was when I partnered with my now partner, Colin Schwartz, he was starting. What he didn't have that I did is he didn't have an attorney job. So he quit his job cold turkey. He just said, this sucks. His story's great. He looked across the cubicles and he saw somebody who was like 64 who had like a 1,000-day rip-off calendar until the day he could retire.
Oh, jeez.
And Colin was like, this is miserable. Why am I here? He quit it cold turkey. And the only option was to manage it yourself. So he started the property management company in-house at about the same time that we partnered. And that's what helped. And it wasn't until recently, even Colin and I have reached out to even more successful and larger operators to now come in-house, and they handle all of it for us. Tim Farha, Nate Farha, Danny Humsey, they do everything for us at Point Guard. That's an in-house affiliated property management company. And that's because they're awesome at it. Over 3,000 doors that know what they're doing. Now Colin and I can go out and raise money and build the equity company.
Wow. That's phenomenal. And like you said, I think so many people, you touched on something right at the top, to be a good CEO, your main job is to surround yourself with people that are going to be smarter in every area of the business that matters. And if you can that's so easy to say out loud for so many people that have never really run a business before. It can be such a difficult concept to grasp because it feels like you're giving everything away when you partner.
Look, I'm still not the best at it. I'm not the best at delegating. It could be the Uncle Rico in me. I played quarterback in high school and college football. So I always want to be in control and do ridiculous things. But if you really want to be successful, you got to let go of the reins in certain areas and let people take over. It took me a while to learn that, but it's a work in process. And I think you hit it on the head. If you want to be successful, you need to get some badasses around you.
So how did this evolution actually start? So I think you said something really important. So let's start here. So you decided that you knew what you were strong at and you knew what you weren't strong at, or what other people were stronger at. So when you do kind of your self check-ins, what do you rate yourself very strong at? Other than hair.
Well played. I honestly think I'm really good at underwriting, but if someone had a full-time job and they want to do that's fine. I feel like I'm pretty dang good at underwriting. I really understand numbers. It's something I've been like. If I have to sit down and do a bunch of quarterly reports for all the investors, which are very, very important, it may not excite me very much. We have people on our team who can do that better than me. If I have to, for some reason, underwrite for the next 4 hours and I somehow can fit that into my schedule, I weirdly get off on that. And so underwriting is a lot of fun for me, but we've had a full-time underwriter on the team now for a little bit. I think I'm good with people. That sounds self-serving, but I feel like I'm relatively empathetic to people's positions, and I'm not a salesman. I'm not a trained salesman. I've never had a sales job. I think I was a bank teller when I was like 20. And if that's a sales position, then sure, I've had that when I was 20. But other than that, so I feel like I'm viewed upon as authentic because I sincerely am. But that helps us raise a lot of money because we're putting the money into the deals. I wouldn't put my own money in a deal that I thought was going to fail. And I think people see that authenticity. So I like working with people. I like working with investors. And right now, I'm just really loving building the business, thinking outside the box, that whole entrepreneurial spirit thing. I feel like I'm good at it. I think it's because I just don't want to lose. I always want to succeed. And so one of the things I'm bad at and I'm getting a lot better at is letting go of the reins. It's taken a while, but it's why we're at this many units is we let go of that in the last few years. And that's what I'm trying to get better at.
Nice. So you know what your strengths are, you know what other people are stronger at. You make the jump to multifamily in 2017. Like, at what point did you and your partners realize that there was an opportunity for you to do better at property management or construction? Like, what was that? What were that series of events you're like, maybe there's more to this than just raising money and structuring deals and closing on deals and hiring third-party property management?
Yeah, I like that question because I think I have a chance to highlight here. Like, I think we lucked out. I'll be the first one to admit the fact that I started in 2013 and I've been doing it for 10 years. I lucked out because of the way the market cycle was. There's no question about it. That doesn't mean everybody succeeded. There's a lot of people that didn't succeed, but I lucked out there. I think we lucked out, which is partially because of our trepidation to get really jump in. But what I mean by the fear to jump in, that meaning lucked out, is that my first deal, I didn't try to syndicate $15 million and take down 500 units in Houston. Like, that wasn't my first deal. So my buildup of single family, doing everything myself, to a duplex, to a 20 unit, to a 70 unit, to doing everything, to letting go of one thing at a time, then to finally turn into syndication, because some of my fewer beginning deals, like the 12 unit I did and a 20 unit I did, those still weren't syndications, So I didn't have to learn PPMs. It was a couple investors. That trajectory, I feel, helped us be successful and learn along the way. Okay, we're getting bigger. We're bigger. Now it's time to offload this. Now it's time to offload this. And I think it's just being patient, but always pressing yourself to move forward.
I think that's huge. I mean, 100%.
Yeah.
And, going back to you as a leader now of the business, I think we sometimes almost downplay the merit and skill involved of being the vision caster for the business. That's where the realization of we've got to vertically integrate comes from, right? If everybody's just in their groove, in their role, doing the thing that they're doing all day, but nobody's looking for the new opportunity or the next opportunity or the next chapter or the next iteration, the business stays the same or gets stagnant after a while.
Yeah.
And so I notice that because oftentimes leaders, when they ask what their strengths are, they kind of struggle with, because we're so dialed in at delegating and trying to find smarter people than us as leaders. And I think we forget sometimes that our job is to think in a certain way.
And I think you're onto something. So I do this with, my leadership team at my W-2, right? We'll take a day every once in a while, probably twice a year, right? And either for a full day or an afternoon, just get out of the office, right? Put the cell phones away and just talk, right? Sometimes we just get so caught up in the speeds and the feeds and the metrics and Salesforce.com and all this other stuff where you need to kind of just detach from that and really see what's going on around you. And I think we did a war room a couple of months ago. It's probably time for us to do another one here pretty soon, right? But sometimes you just get caught up with executing the day that you need to take a step back and execute the quarter, the year, kind of the long-term plan. And it takes that clarity and that ideation to really kind of figure out how to grow the business instead of just make the business go.
So Chris, speaking of like the execution of game plan, right? So 2013, you get in, you're like, oh, it's kind of luck of the draw, right? Just like you said, you got lucky on that. But it could also, I've seen a lot of times where you said lucky. I've seen other people who kind of use it as a curse, right? And what I mean by that is you were buying things at a much lower price back then, and then we experienced the COVID run up. And what I've seen, and it happened, my brother the same way, where we were buying properties and then we would start looking at it like, no way, it's too expensive. I was buying over there in that neighborhood when it was $10,000 a door. There's no way it's worth this. And then it hindered us from buying more opportunity over there. So how have you guys kind of shifted your game plan on, all right, you got in, you've got a lot of doors under management, and now you're definitely paying higher than what you were back in 2013. Yeah. And now rates are higher and everything else. So how has that game plan shifted?
Well, I think that our approach is really for what helps us, and our approach is that we're a long-term hold. So if you can get the right debt, and if you feel comfortable in your underwriting and it will cash flow and it'll cover the debt, and you're not worried about trying to flip it in 4 months and hope it all works out, then you can kind of ride out these market cycles. There are a lot of people who are saying, and there's nothing wrong with this. This isn't throwing shade on anybody. I mean, people had a lot of money flipping apartments and homes, and good for them. And I'm sure it changed their life for the better. But the problem with that is if you're left holding an asset and the market changes in a short amount of time like we saw, it can really affect your approach. And you have no choice because you don't have the best debt, and or your investors weren't ready for that big of a switch. But like right now, we're taking down a deal. It's only about $15 million up in Sioux Falls. We're assuming a HUD note at 2.6% for the next 33 years. Ooh, and what we're telling people is we're holding this damn thing. Yeah. And in 6 to 8 years, we're allowed to refi if we want to and pull cash out, which is what we want to do. But don't expect money until then. They'll get cash flow, but I'm saying don't expect a refi or a capital event and then. And by the way, if the market's still shit, we have a 2.6% note. And if everybody's okay with that, then you can kind of flow with the market cycles. And I understand it's a long answer, Nick, but our approach has been to maintain what we always have. We're holding these long term. If you get good debt, then the market cycle shouldn't matter. Also, I feel like every answer in mine's like 48 minutes. It's like I'm charging you guys like I'm still practicing law or something. But also, if if you buy things like we do, which I understand this is also an I'll use two overused phrases, rich dad, poor dad, and value add.
Mhm.
If you're buying these things, in our opinion, where there is meat on the bone, not for a flip, but just to raise the value of it. And I'm not even talking about NOI compared to cap rate. I'm saying, can we get more income and can we lower the expenses so that we cash flow? And that amount of cash flow is a significant amount enough above the good debt. If we can do that and we buy something now and in 5 years the note balloons, we're not relying on this organic growth. We're not underwriting to Dallas growing like it has the last 5 years. We just want to make sure there's a lot of meat on the bone so that even if in 5 years the market's still terrible, we've raised the cash flow and the value enough that if we refi and don't pull any money out, we're relatively safe because we have gotten so much income. It's just long-term planning.
Yeah.
Yeah.
You know, I actually I appreciate that long-winded answer, because that is what so many investors need to hear. And what I mean by that is that was a very in-depth and informative and thorough way of saying you guys have a very simple investment thesis and you stand by it. Keep it simple, stupid. Like, if you're sitting at your underwriting model and going, here are the 14 different things that we are going to consider as far as raising the value of this asset so we can dispo it on this timeline or whatever, right? Like, you can start to really pencil whip your deal and fooling yourself into thinking that this asset is a better deal than it is. Where your investment strategy is, can we raise the revenue and the income enough that with the debt product that we are going to be using on this, we are increasing our cash flow to an amount that is adequate for our investment thesis? If the answer is yes, this is a deal. If the answer is no, what are we talking about, right? And I think that, especially with, we're seeing so many deals that are now in trouble because there was not a simple enough investment thesis that just took common sense into the equation. You know, that's where you get deals that didn't need massive capital improvements on bridge debt and things like that. You just had so many different ways of people pulling all these levers to get all the juice they possibly could out of the squeeze. And you guys are going, is this property in a condition where we can improve it to the point where the cash flow is good enough for us to hit our returns in a very simple way? And that seems so common sense, but it's not what a lot of operators practice.
Agreed.
You know,
Agreed. I think the long-term outlook is really important. And, the last couple of years, I think everybody was very intrigued with not just the transactionalism of multifamily, but, we're going to go in, we're going to find mom and pop deals, we're going to buy them, we're going to put them on bridge debt, we're going to put a bunch of CapEx in it, we're going to raise the rents, and then we're going to refi out, we're going to have all this money, and we're going to make our investors rich, and then we're going to go find the next deal until you can't, right? And I think the long-term debt and the long-term outlook of Chris's strategy is really sound, right? But honestly, it was hard in the middle of all the hype. I was underwriting a ton of deals and everything was overpriced, and you had to get 80% LTC to make them work, and you were betting on continued compression of cap rates in order to make returns. And retrospectively, I'm glad we didn't buy any of those deals, but it was just kind of, you're caught up in the market hype around you, and you just got to take a step back, like we were talking about before, and just realize, what is your investment thesis? Don't get pencil happy, and stay in your lane and wait for the right one to come down the fairway.
Yeah. I mean, we've seen it in our business now. This is, mark our words, every LOI that we have submitted that we did not get in the last 6 months, and somebody got it for higher, that deal is not closed.
Yep. Chris, how's as you go and find opportunities, and you said you're, in that capital raising portion of it, how have your investors responded to that, where it's like, all right, this is a lot longer hold than some of the other ones, right? They're seeing other ones where usually the pitch is 3 to 5 years, get in, get out, get your money, get your cost egg, tax saving, blah, blah, blah. This one here sounds like, all right, in 6, 7, 8 years, we're going to analyze this. And we're going to hold this for a lot longer. So how has that response been? Because that's kind of a different, that's a little different than what I've heard in the past.
It's certainly a conversation we're having all the time. And I think they understand, it's not, turn on social media or TV or something. Everyone knows that something at least is going on in the economy. So if my answer to them is, look, you're going to get some cash on cash every quarter, and instead of us refining in 4 years, it's going to be 6 or 7. we just haven't had a lot of pushback. And anybody who says that's ridiculous, I demand 3 years, we wouldn't want to work with. And I can tell you, we haven't really had that kind of input. So I think what helped us out is we do have a track record. I'm able to say, I think our investment deck, we have to change it every once in a while, because the investment deck used to say, we average our deals in an average of, we refinance our deals in an average of 18 to 30 months. Well, that's going to have to change. And it is. I mean, that
Sure.
deal, like I just said, is 6 to 8 years. I have another deal that's live right now. We won't refinance for 8 years for sure. And I think that people are just understanding how important that is. It has not been that difficult for us, but it's a question we get a lot. Why? But after you explain it to them, they completely understand.
What do you? So I appreciate that answer, and obviously you mentioned the cash flow is the play for them as well. The cash on cash. What are you targeting with the macroeconomic environment we have right now? What are you targeting cash on cash wise to make your investors go, okay, this is my money safer here than it is in bonds?
So we need to be cash flowing day one without touching it. That's one of our rules. It doesn't have to be a lot.
Yeah.
But it certainly has to be at a comfortable level that the lender would bless off on the DSCR, but also so that if for some whatever reason we're not stuck holding something that negatively cash flows. Now, let me back up for a second. We have 61 open deals right now, legitimately 61 properties, 61 open deals. 59 of those are fixed rate mortgages. I have 2 deals that are variable. They have rate caps that they're more work intensive for us. There's no question. So I don't want to come across as though we're perfect and we've done everything perfectly and we foresaw what was going to happen. It's a lesson learned, no question. But if you still have that long-term thought process in mind, I think you can be successful in the end. But I think it's just really important to give a cash on cash to your answer. We're looking at least cash on cash year one. We don't even like looking at it really unless you can barely touch it and it cash flows over 6%.
Yeah.
Right now, that's not that exciting, but if we underwrite conservatively, which I feel that we do, we're looking at 7, 8, 9, 10 over the next 5, 6, 7, 8 years. And the reason that is because, here I am with my long answers again. The way we underwrite is we say that by year 3, depending on the size of the property, by year 3, we think we can make this asset perform like it should right now. Not how we project the market will change so that it'll be right now plus 3 years of organic growth. We're saying if you snapped your fingers right now, you turned all 100 units here and you raised the rent just to what they're getting right now, that takes us 3 years. And so that conservative buildup, I feel, allows us to say, look, if it's going to cash flow that entire time and we do it in 2 years, we're already ahead of the curve. And that is what makes us feel very comfortable. So our investors are really comfortable with that 6, 7, 8, 9, 10% cash flow.
Hey, man, you can take as much time to answer as you need. If you keep dropping wisdom like that, brother. I people, if you're listening, go back and listen to the last 30 seconds again, because I want to pull out 2 things that you said. One, cash on cash, just having one cash flows from day one. I do like the idea of at least 6% because you're beating treasuries and all that type of stuff. But you just made a really great point that has been so lost and has gotten a lot of deals in trouble right now. Is you are looking for assets that your investment thesis is there is an arbitrage right now between the way the asset is performing and the way that it could perform in the particular market environment that we are already in. And that is your investment, or that is your investment strategy. Whereas most deals that are in trouble right now, the investment strategy was based on a continuation of rent growth and other variables staying the same, like rates and taxes and insurance and all that type of stuff. And when we get to year 3, the future should look like this. This is what the market should look like in the future. Your investment thesis is the market should, or the market does look like this right now. This asset should perform like this right now. And when we execute our business strategy, we will make it operate the way that it already should be operating. And it's going to cash flow from day one. That's about as simple as you can possibly be. And it's a hell of a way to make money.
Yeah.
You know,
question for you, Chris. You've talked about underwriting a couple of times, and I know you said you had a full-time underwriter on staff, but how have your underwriting assumptions changed since the economy has changed over the last 12 months?
You know, we haven't changed a lot of our rent growth. I think we started at 2% back 6 years ago. We're still underwriting at 3% rent growth, which we're seeing way higher than that. Whether that comes down or not, I don't know. That's a whole 8-hour podcast about inflation and where our market's going. I have no idea, but we're still at 3% rental growth, which we feel very comfortable with. We've docked up our expense growth to at least 3 or 4%. We used to be at 2%. And really it's just, we're trying to find debt long-term. You know, one of the ways we're making deals work recently, we closed a portfolio a few months ago. And one of the questions I get a lot is like, how are you guys still finding deals? A lot of times the deal comes to us and that seller is still 2 years ago in their head. They'll say, hey, this is worth 10 million. Will you buy it for 10 million? And there's no way. And one of the things that I've personally succeeded on is I will provide them my underwriting and I'll offer them, let's sit down. Zoom's awesome now. Yeah. Let's go through my underwriting. If you highlight where I'm wrong, and this isn't I told you so, I'd love to be wrong. I want your asset.
They jump on Zoom and they're like, oh, look at that guy's hair. And now you got their attention.
And then they're just mesmerized by the hair and they sell it to me for whatever I want. No, if you show me where I'm wrong, I'm all ears. And a lot of times that ends in one of two ways. I get the deal at a lesser value, or they say, you're right, but Chris, we're swinging for the fences here. And by the way, I don't blame you. Swing for the fences. Shit, I've sold stuff swinging for the fences. And I was like, I'd never buy it for that, but they bought it for that. So good for them. As long as we can have an honest conversation, I'm just not the right buyer. It doesn't mean it's a bad deal at all. But why I'm succeeding right now, or our team is succeeding right now, is that we're being really creative and we're saying, look, it's not worth 10 million. Here's our underwriting. And it shows you it's not worth 10 million. That's not a shot at you. I hope you sell it for 11. It's not worth 10 million. Here's what I'll do though. I'll buy it for 8. I'm sorry. I'll buy it for 10 million. Let's do a $2 million seller carry. Let's buy it. I'll go out and get debt. I'll get debt at 7, 8%. I'll get debt from Fannie right now at 6%. And then you carry $2 million for us, 5% interest only for 5 years. Now it makes sense. They get the 10 million they want to. They can spread out their capital gains, and it makes them feel like they got that 10 mil. They'll get it sooner or later. And by the way, now we have to bring way less capital to the deal, and it makes a lot of sense for us. So that being creative has really helped us take down a lot of deals. Listen, we closed a deal recently with 4 deals. So one syndication owns 4 different apartments in 3 different states, and every single one of them had seller carry on them.
Wow. That is incredible. I mean, like you said, just getting creative.
Can we dig into that one a little bit?
Go ahead,
like,
please.
I was going to say, he got excited on that one.
I did. Like different states, different deals, syndication. I'm like, oh boy, here we go. Yeah. Walk us through that one. How'd you find it?
Well, we've done that 7 times now, and that's not an homage to my hair and my awesomeness. That is what happened is in the golden rule that I still feel to be true because of scalability, like you've already discussed, is that managing 200 doors is the same damn amount of energy as managing 20. And what I learned as a single family, you think that would have made me jump. I'm glad I didn't jump to 200 right away. I learned a lot along the way. And any mistakes you make at a smaller scale are not as bad because it's a smaller mistake or it affects you less financially.
Right.
But what we learned was we're like, holy cow, we need to get bigger and bigger and bigger. And we did that. We kind of had an internal rule, like we're going to 20 units, like get out of my face. And then we started realizing, shit, we built kind of an attraction here and a good relationship rapport with investors and bird dogs and wholesalers. We're turning down a lot of 25 units that are really good deals. Yeah. So instead of passing on them, we said, you know what? I'm going to buy this 40 unit in Kansas. I'm going to buy this 30 unit in Omaha. And I'm going to buy this 50 unit up in Sioux Falls. And now, I don't even know the numbers I told you. Is that 100? I hope it was.
120, yeah.
There, whatever I just told you. Now the investors getting into that parent entity, Midwest Portfolio 3, they now invested into that entity and they own 100 doors. And the scalability is a little different. It's a little more time, of course. We're dealing with a couple of different property management companies. You know, we talked about earlier how we're in-house property management. That's only half our portfolio right now. Yeah. So right now we manage 1,300 units of our 2,700 units. It will soon be 1,700. But man, we have a couple of third parties that are just doing so well for us in a couple of locations. It may not make a lot of sense. Regardless, we have different meetings with the property managers. We have that whole portfolio. So sure, there's some additional meetings, but the scalability so that if the 20 units only 80% occupied, the 50 units at 96, it's not as scary to us. And that's why we started throwing those together. It's like, why would we pass on these smaller opportunities if we could still build that scale?
Man, that's amazing.
That's great.
Love that. Love that. When you really quick, I know that we're almost diverting here. Going back to the vertical integration for the property management, I'm almost just asking this for my own knowledge. how did you make the jump into, somebody's got to jockey that, right? It's essentially its own company, right? That serves you as the one client, but without getting spread too thin. How do you, did you just happen to find the right talented person to go and spearhead that? Like, what does it look like to bring on that vertical integration and not have it suck up, become something that sucks up more of your time and it actually does streamline? Is it just about finding the right talent?
Well, I mean, I kind of already admitted that sometimes I don't do the best job at delegating, so I'm still pretty heavily involved. I work a lot.
Yeah.
This is cliche, but I freaking love doing this. So like my wife will leave town to go to an Adele concert and you'd think I just binged Narcos or something, but instead I'm just like deep into underwriting and looking at deals like a loser. And I love it.
Yeah.
But I'd say that we just have a good team, and that's not just fluff language. We have a couple acquisition guys. That's all they're doing. They're out there trying to find deals.
Yeah.
So maybe if I throw a portfolio together, and when I say I mean our team and our co-founder Colin. I mean when we're looking at this stuff and we're throwing together a portfolio like that, maybe we have an acquisitions guy up in South Dakota that found a deal, and the acquisitions guy down in Wichita found a deal. And I'm still getting contacted. I've been in the market for the last 10 years, so I'll still get a call from an agent or an off market. We're getting a lot of off market stuff directly from agents, by the way. And it's because I'm calling it off market because I haven't listed it at all.
Right.
But we have a couple of agents who will call us and say, look, they won't call us. I don't want to guess, but a high majority of their sales are only to us. And so what they do is they do all the work, mailers, calls, finding the actual seller. But what they can sell to the seller is this. Instead of putting on the market and dealing with landscaping and all these pictures and all the 18 million LOIs and the 4 that drop out, I have someone that will close for you in the next 60 days. I've already closed the last 7 with them. Let's not dick around with this.
Yeah.
Let's call this guy. And they give us off-market deals all of the time. That's how I found this 2.6% note. It wasn't marketed. They just knew they had someone that would close. And so you talk about these different avenues on the way different deals are coming in, then it really is just the same damn thing earlier that I was saying is a 100 unit. Yes, I have to underwrite this, or we have to underwrite 3 now. But I have 1 set of legal docs. I have 1 asset manager who's overlooking it, who's going to help us look at these things. And we have a couple more phone calls with on-site PMs. So it's not a lot more work than you'd think. It's a tad more than 101 location, but it's worth the extra amount of work for how lucrative it can be.
Yeah, 100%. More diversified too for the investors as well.
I say that all the time. I'm glad you said it. I mean, shoot, we had one that was, I say Class A. It was just built. But no amenities. And it was teamed up with a really heavy lift down in Wichita. And talk about different states, different locations, different asset types. It's a great way to diversify.
Yeah, 100%, man, 100%. That's a hell of a strategy. I haven't heard a lot of people doing that.
How did you create how did you get comfortable with investing in so many different markets?
Yeah, so we won't get into a market if 1 or 2 things happen. We won't look at it unless there's over 100 units. So we need some scale there. And once we're there, then shoot, we'll buy a 9 unit. We probably won't syndicate that. We'll probably take it down a couple of us. But also, we will not go there ourselves and think that we know the market. So I'll be honest, we paused a little bit because we feel pretty comfortable in these 7 these 7 markets that we're in. So taking on a new market right now, it would take a pretty good deal, which isn't the easiest to find. And/or we always make sure that when we move into a new market, we find the best third-party property manager we can to take over because they have all the experience there. Instead of moving there and thinking we know anything about the market, we want to make sure that we're comfortable with the third-party manager if we're going to move into a new market. There have been times, and they know this is coming, that 2 years later we take over ourselves, but they make good money from us, and we did well. And it really is just making sure we feel comfortable with them. Another thing we do during underwriting is we underwrite the deal with the property manager. It holds their feet to the fire to actually match the income they said they could get and the expenses they said they perform at, but it helps us understand the market better. So it's this process, and it's the reason we actually haven't done it. I mean, our most recent, Texas is the last new state we moved into, and that was 2 years ago. So we're being hesitant and cautious.
But how did you get comfortable with, like, Texas is a big place, right? You got Dallas, you got Austin, Central Texas.
Yeah.
We have a bunch of complexes in Arlington. Arlington's completely different than Garland or Richardson. Those
Third
assets
party.
just,
Third party management.
Okay. But
So
like when you're underwriting a deal, aside from you have to do some initial screen. Your property management company is probably not going to adjudicate every single opportunity that you think is good. So how are you getting comfortable with the market trends and the data and the rent growth and the vacancy assumptions and all that stuff in the markets that you invest in?
yeah, so we'll do a couple things. First off, we have CoStar. We look at things like that.
Yeah.
We underwrite it to what we think it's going to be successful at without even talking to the property manager. Now, again, I'm only talking about this hypothetical where we have never been there and we have no connection to any third-party property management. And if the numbers seem to look good on a T12 and a rent roll, or close enough to where like, look, I don't know enough about this, but right now this looks pretty tasty. I wonder if someone can give me a little bit of input. That's when we'll reach out to a third party. And it actually wasn't that difficult. And again, where I'm lucking out is that I'm not just some like guy who saw a YouTube about syndicating. I'm not big. What I'm saying is when I call them and I say, hey, I have a deal that we have under LOI. Would you help me underwrite this? If so, we're at the same time, we're interviewing you as a property management company because of the traction we built in our experience over the last so many years. It doesn't seem like a waste of time for that PM to look at that with us. So then they can utilize all of their sources because they want the deal. We have a line of people, and I'm not exaggerating. When we took over in Texas, we had 5 property managers, all well-known. You probably know all 5. And they all wanted to be a part of it because they were good assets. They underwrote well, and they knew we weren't tire kickers.
Yeah, that's huge. I mean, that's just, building the track record, I think, is what opens a ton of doors. That's huge, man.
You see, the reason I'm asking this is because I have this kind of intra-conflicting conversation with myself, right? Where I think we've been very successful being very, very focused on certain markets, right? I don't think there's a broker in North Texas that doesn't know we have a number of assets in Arlington, and if they get a whiff of something available in Arlington, that we should be one of the first 3 people they call, right? And I think we're building that kind of traction in Waco and some of the other markets that we invest in. But I hear Gino in my head saying, be very, very focused on where you're looking for deals, get very, very familiar with those areas. But then I see like Omaha as a very promising market. And
you can stay out, please.
Huh?
You can stay out, please.
Maybe.
I'm kidding. I live here. This is.
No, I know.
I interrupted you.
Don't worry. I'll call. We'll offer the JV. Don't worry.
Good.
Especially now that you've been on the show. There's other markets out there, and sometimes it's difficult to fight the temptation to stay in your lane or go expand.
Yeah.
And so in the market, you started in Omaha, Chris?
Yeah, so I live here. We started here, and the only reason we left is because the deals seemed to dry up. But yeah, we started in Omaha.
So you needed a bigger deal funnel.
Yeah,
got it.
And you know where did you
land? Where's your second market?
Kansas City.
And why?
I knew a guy down there doing the same thing we did. He loved the deal. He brought it to me. He didn't bring it to me. He said he actually would have taken it, but it was under contract by one of his friends who gave it to me. And he lives there. He does what we do, and he was an agent himself. And he said, this is really going to work. And it really has worked. And the third market was South Dakota. And what we did up there, and I interrupted you earlier, was we JV'd with somebody who lives there. We love South Dakota. I went to college in South Dakota, so I knew the market, but I didn't invest when I was in college. But we JV with boots on ground, and they could watch it. They could look at it. They already had invested up there, and that is why we try to be safe when we bump in like that. You guys know so much. It really is just making sure you trust the info that you're being given, and it usually isn't from the broker, with all due respect. It's usually from somebody else.
Yeah. So real life use case, right? We had a lender on the show, Brian from Terrydale Capital, like our second or third episode. Great guy. Great episode. And like 2 or 3 weeks later, we get a call from someone in his office. And he's like, we have this deal in KC and we're having trouble doing the raise on it. And we want to bring you guys in. And so we were like, yeah, let's do it. It wasn't that big a deal. We're like, we can take this down ourselves. No problem. And then they sent us the underwriting and it was a shit show. Right. And, I'm like trying to chug forward and make this thing work. And somewhere along the line, I lost Brian and Nick because although we trusted the source of the deal, didn't trust the underlying information. Right. So even after we put it in our own template and made our own assumptions and stuff, it was difficult for everybody to get on board with the kind of hell yeah or no concept. And we ended up passing on the deal. And what you just said about really trusting the source,
Yeah.
right? It resonated with me because I think that's really, really important.
Yeah, I think you're right.
And that, I mean, that would have been a great way for us to enter a new market, but like the tea leaves didn't line up the way we all, in a way that made us all comfortable. Huh?
Are they already there in KC?
They were. Yeah.
That's what we kind of lean on, but
yeah, it was a good lesson learned for us. 100%.
Yeah,
100%.
But I know now we know people there, right? We know some of the market dynamics. We have access to the data up there, and we'll look at that differently next time around. You know, these guys were making. We asked them about their R&M budget, and their response was, "Well, a lot of the tenants fix their own shit, so we figure they're going to keep doing that." And we're like,
I was like, now when you raise their rent by 25%,
yeah.
All of a sudden they're not unclogging their own toilets.
Yeah.
You know?
Well, they say some of your best deals are the deals you passed on, so you probably made a good deal.
Yeah. I mean, it would have been good. It cash flowed nice anyway. You know, no rear view mirror stuff. It was just very something what you just said about having, you know, trust in the people that bring you into new markets it just kind of hit a nerve. So thanks. Sure. Yeah. Knowing how you've grown, Chris, I want to be considerate of your time. We're coming up on time here in a second. You started in multifamily. You started in single family. You went to multifamily. Then you started your own property management company. You've expanded into numerous markets. You know, if you had to take a step back, looking at your journey in the last 2 years, and give our listeners like the most important piece of advice along the way, what do you think that would be?
Can I choose more than one piece?
You can.
Absolutely.
You can. Good debt is extremely important. When the world's peachy, nobody cares about debt, especially when you're aggressively underwriting. But if you truly want to hold this long term, or if you plan on flipping and you have no idea what the market's going to bring in the next few years, you should make sure you find some good debt as a safety net. If the deal doesn't work, it's a huge risk you're taking, but I suggest good debt. One of the lessons you said in the last 2 years, but one of the lessons that I kick myself for is when I was in my mom's basement in law school, and I read that purple Bible, I wish I would have started then. I wish I would have bought a duplex and house hacked it. I wish I never would have sold anything. I wish I never would have sold a single thing that I've sold. I've made really good money selling stuff, but if I still held it, I'd still have more money that I don't have to do anything with every month coming in. So the two biggest lessons that I continue to push to anybody I speak with is to hold more, so don't sell, and buy quicker. Stop questioning yourself. Be smart about it. If you don't know anything about anything, don't go syndicate a 100 unit.
Right.
But if you're passionate and you're good at underwriting, or you're good at knocking on doors and talking to people, or you're good at raising money, or you're good at risk management or construction, find someone that fills in the gaps that you don't have and take a swing at it. Yeah. Start with a duplex, start with a 10 unit, mitigate your downside. But this whole, you guys would know the phrase, what is it? Paralyzation of analysis paralysis. I know so many people, and the questions bother me. How'd you do it? How'd you get started? These are important things. And I don't mean on a podcast. I'm talking about people that I know. And it's like, I know all the same things you do. I've seen all the stupid podcasts you did. Not that a podcast, but we have our own podcast. Yours is great too.
Thank you.
But all the books, all the YouTube, but that's all you've done. You've actually only spent money on Audible and all these books you listen to. You've never put an offer in on a deal. Get up and go do it. And I think that's the issue, is that people's fear hold them back. So that was a really long-winded answer, and there's at least 6 nuggets in there. But
that's okay.
That's what I would change if I could of my own self over the last 15 years.
I like that. And listen, your long answers are awesome, because I think at one point or two, Brian asked you like 6 questions at the same time.
Yeah,
so it's all
we're going tit for tat on the long-windedness here, right? I've met my counterpart.
Brian, what else you got for Chris?
Man, I truly appreciate it. Like I said, I want to be respectful of your time, but this is, if you're still listening to this right now and you tuned out or whatever, this would be one to please go listen to again. Of course, you have not only it's been great getting to know you, but you've brought a lot of actionable advice to the show. And unlike some of the more fluff pieces podcasts out there, we try to keep this as actionable as possible and be as detailed as we can. And it's been really cool learning a little bit about your journey and the actionable advice that you've been able to give, man. So we really, really appreciate the time.
Yeah, I appreciate you saying that. Thanks for having me on, all three. It's been a lot of fun. Sincerely.
Chris, where can people find you?
Chris Pomerleau on LinkedIn, Instagram, TikTok, I don't know, Facebook. I don't always do the best job of checking those things. You can email me to chris@leavenwealth.com. I'm sincerely always willing to answer questions. It can be difficult for me to hop on multi-hour phone calls, but if I can make good connections for you, I'm always happy to do so.
Beautiful, beautiful, man. We appreciate the time. Thanks for listening, guys. Make sure you check out deepbluere.com and sign up for our newsletter to find out what we're doing next there. And brother, we're going to have you back on soon.
That'd be great. Hey, I'll be down there at DFW in the next few weeks looking at some of our properties. I'll have to hit you guys up.
Let us know, man.
Yeah,
yeah, absolutely. We'll grab drinks.
That'd be great.
All right, brother.
Thanks, Chris.
Take it easy,
Thank
guys.
you.
Thank you.
Thanks, everybody.